Welcome back, everyone. Good to have you here on Short Verticals. I'm Brett Crowther on another Thursday. Actually, another Thursday. I wasn't here last Thursday, right? I was in Chicago, and so it's good to be back with you this week. And so it's been interesting what has happened since the last 2 weeks. Now we have some trades that we placed on that we need to get back, take a look at, see how they're doing. We got to talk about just generally what's going on in the market, and that. And then I want to go through some questions that frequently come up kind of around implied volatility and how it impacts the options, and in particular these spread trades that we're going to be talking about. And then, of course, we'll place some trades if they're still there. It's so funny how I'll go through and set up some orders, like do some analysis and stuff. And then it seems like on Thursdays, the markets can move quite a bit. And all of a sudden I get to the class an hour or two later and, they're not there. But hey, that's the way it goes, right? So, hey, want to welcome everyone aboard. Thank you very much for joining us today. Sam, Trisha, Williams, Speak Truth, others. Yes, a lot of you in there. Hey, thank you for joining me. So give me just a moment. Let me cover the disclosures real quick, and then we'll get right into it. So do remember that options do carry a high level of risk and are not suitable for all investors. Information here is for general informational purposes only and should not be considered an individualized recommendation or investment advice. Um, Paper money is for educational purposes only. Short options can be assigned at any time, regardless of the in or out of the money situation. Investing involves risk, including the loss of principal, and past performance is no guarantee of future results. So here are some option Greeks. Do note that also that a stop loss order is not a guarantee. All right. Let's see. Let's see. Looks like we're all good. Okay. Let's jump over to the chart, shall we? Now, it's been an interesting week because, gosh, we've had a lot happen since the last 2 weeks. I mean, we got the market's doing well today. Now, it really is heavily, heavily weighted by, what happened with NVIDIA, right? NVIDIA came out and said, just kind of smoked their earnings. And really their forward guidance is really what it was, talking about how they're looking to grow 70% in the next year. And so, people are taking that as looking like NVIDIA is good, that AI, all that stuff still has some opportunity. And so the stock jumped up, and some others in that same arena also jumped up as well. And of course, that's helping pull the market up, right? But the breadth of the move isn't real strong at the moment, right? But we got a lot of things going on. I mean, tomorrow we're going to hear Kevin Warsh talk after he's, he's not going to do Q&A, but we got the Fed chair at the symposium in Jackson Hole, and it's his first major speech after becoming Fed chair. We have a lot of things going on with, like the Japanese yen. I used to teach currency for quite a while. I've been doing this for 22 years. And for a chunk of that, I helped develop and present a currency course. And so I follow the currencies deeply. But anyhow, it's been really interesting to see what was going on with the Japanese yen, because the Japanese central bank buys a lot of the U.S. debt, right? And so what we saw is those long-term 30-year yields were rising. It was getting a little bit concerning. So the Treasury jumped in not only to buy back some of the long-term bonds, trying to bring down those long-term yields, which was kind of unusual. It basically doubled what they're doing, about 2 billion to 4 billion, but said they could go up to potentially a trillion, because that's what they have in the general account. But also stepping in and weighing up the Japanese yen, saying, hey, we need to help support that, which is something they haven't done since 1998. Now, they've intervened a couple of times, actually one time to help keep it down, but really to buoy it up hasn't happened since 1998, when you had the Asian financial crisis. And so there's a lot of interesting things that are going on out there, but overall, the market's still taking it in stride. It's really holding in there. Okay, I mean, taking a look at what we have going on, let's minimize the RSI for just a moment, bring this down a little bit. We've had this rally run up and pull back. We can see there's a couple levels of support in here. We could draw a line across the tops. Pretty simple, right? Old high, similar high, now new support right there. We could also try to see if we have a new, well, if the support level is confirmed by Fibonacci. So I'm going to take it from this low down here. Really, when I'm drawing Fibonacci, I'm trying to find major lows. So there's a major low up to the major high right here. That's the distance I want to go. So I'm going to draw that Fibonacci from that low up to the high, and it'll give us potential areas of support out into the future. And that's one of the things that's kind of nice about the Fibonacci is most indicators are actually backward looking. The Fibonacci retracements is a little bit more forward looking, right? And so let's do this. I mean, it's already pulled back some. We'll just see if it confirms any of them. And it looks like the 38.2% is essentially where that old resistance, now new support was. And so it kind of confirms that area as a support level that came down, bounced off, and looked ahead higher, right? And so a couple of things converging to say this was a support and helping the market stay up. We got also a couple comments here. Oh, could I share your five basic black chart up this? It's pretty bland. It's actually let me clean up. I'll share it next time, okay? Because actually there's nothing really. I mean, it's all the same thing. It's just five blank charts with an RSI and a 30 period or 50 period moving average. But let me do it. Okay, audio's a little choppy. Maybe we could kill the camera and see if that helps clean it up. I know we've had some internet issues around my area recently, so that may be playing a role. So hang tight with me if that's the case. The neighbors complained that theirs was going in and out as well. Palantir is a hot stock, nice premium on selling options. Yes, and so that's going to play right into what we're going to be talking about today, which is about the options and implied volatility and how that plays into these options. Okay, but first off, let's take a look at what's going on with the trades that we had from last or 2 weeks ago, right? What we did is on TXN, if you recall, we went in and we placed a long call, or not a long call spread, sorry, a short call spread and a short put spread on the same stock on the same months. And so is essentially we put one on the low side, one on the high side, right? One bullish, one bearish. And what we did is we created what is called an iron condor. And I wanted to stress an iron condor is nothing more than exactly what we teach in this class week in, week out. So we think about advanced options and it really isn't. There are a few nuances about how we manage those. And I want to get into that a little bit today. But really, it's no more than just, a short put spread on the bottom end and a short call spread on the top end. We also did the same thing on UNH. Let's go out and take a look at each one of those, okay? Audio and video good there. Okay, I'm glad to hear. Okay, good. All right, let's look at TXN. So let's go to the chart and pull up TXN. And these lines right here, these are where our strikes are, short strikes at 252 and 312. And so when we got into this about 2 weeks ago, it was up here and we looked for it to drop down. Now, this is where it gets a little bit different as far as the management of this. So typically speaking, we almost look at this as separate legs, not one trade. So even though we have like this one trade called an iron condor, you still want to manage it the same way we would just a normal vertical spread, just a normal vertical spread. Meaning on this put side, when it came down, we're just watching to make sure it doesn't break through support. And as long as that support's holding, there's really not much to do except for just give it time, wait and see, when it'll expire. In fact, let's go in there and put our box in there because I believe these are both September 18th. Yep, September the 18th on both this one and the UNH trade. So let's go put a box. Can we get out to September? Oh, we can get way out there. Yeah, we can. We'll draw a box and say, okay, this is our sweet spot. So it was the 14th, 13th or so is when we got in. So somewhere around here is where we got in, but we need to go out to September 18th, which is right there. Okay, so here we go. 17, 18. Okay, so this is where we want to be, is above this line or below that line by the time we get in here. So here's what happens is as it drops down, we're watching the put side. Nothing to be necessarily concerned about, but waiting for it to just hold support, bounce, and hopefully lose value, right? Now on the call side, we're watching that and saying, hey, if that call side diminishes in value enough that we could buy that back, we would buy that back and uncover, basically not uncover it, but basically remove that top side, trade. So now if the stock ran up, wherever it wants to go, it really wouldn't matter. We're looking to basically manage the winner there, take the winner off the table, and then see if the loser can come back in and play out a little bit better. So now if we go look at this, and basically the way I look at the easiest way to do it is we got the put side right here. So if I highlight the puts and then I right click on that, I do create closing order. What I can do is buy them both back. Now you can see this is going to be a buyback for $1.48. And we don't have to do a lot of math to realize, okay, yeah, it's probably a little bit more than what we'd want, right? I don't remember exactly what the price was we got in, but you can just say, you know what, generally speaking, when we're talking about buying back a vertical, we're hoping to do it like at 40 cents or 20 cents or something like that, 10 cents. And so obviously $1.48 is kind of out of the ballpark. It's not there yet. And honestly, we could have figured that out by looking at the chart. Now, let's go ahead and highlight the call side. So I'm just highlighting both of those. I'm going to right click on that, create closing order, and buy that back. Now, see this one? This is about 23 cents. And so this is getting a little bit better. All right. I'm going to in fact, let's go ahead and click on that. Let's buy that back. Let's actually set this order. We're going to drop that down to about 15 cents. We'll go to 15 cents. And leave that as a limit and put that as good till canceled. Just saying, okay, you know what? We'll get a little bit more out of this. We're going to go ahead and pull that off the table. All right. Confirm and send and make sure it's all there. Send that off. Good to go. And so now we have that order saying, okay, and really this is, if it stays down here, drops down a little bit more, or if time decay just wears out a little bit more, that'll probably trigger that short call, removing that short call, walking away with the profits that came on that, and then hoping that price of action just stays above the 220, 252 area, somewhere in here. And then we could do the same thing with our put side, okay? All right. Okay, just checking to make sure we're still on top of it. Okay, let me, any questions on that? Let me know on that, and then we'll go over and we'll take a look at the other one. Let me jump over there. And so the other one we had was UNH. Let me pull that up. So UNH typed in here. Let's see, there's our lines. I was going to say, where did our lines go? They should be in there. And what we're going to see is almost a very similar situation, right? Where since we got in, let's go ahead and draw our box in on this one. So we got in around the 13th. And so we're right about here. And then we're going to go to the 18th of September. So right there, 18. Okay, now it does have a dividend, which that can drop the value of the stock. That's something to keep in mind. Sometimes that dividend can play a role in some of the option trades, especially on the call side, because someone might exercise a call just so they could participate in that dividend. Now, obviously, if the stock's way down here, it's less likely. Nothing is zero, right? But it's very, very unlikely when someone's going to try to buy it from us way up here when they can go on the open market and buy it way down there. But just still, it's something to keep in mind that when you're getting a dividend of like, what is that, $2.32 on the 14th, so that's 4 days before expiration. So if we're not out of it by then, that's something to be aware of. Now, also another thing to keep in mind is that could drop down the value of the stock, and that could kind of hurt where it's sitting on the put side, but help on the call side because the call values, we're further away from the call strikes, right? All right, but let's go ahead and check out how these are doing. And really, it's kind of rallied almost right back in the middle, which is essentially what we want on this trade. And so from a technical standpoint, it's playing out very well. We're really just looking for more time to pass just so this can just expire. So let's go down, click on this. Get off that. Click on these, the 373.80, right click, closing order buy at 222. We're still up there a bit. Let's click on these. 430, 440, right click on that, closing order, 61 cents. Now this one's getting a little bit better, right? This one's getting a little stronger. Now, let me go back. And I'm not going to pull it up. I was going to say, going to go back and just pull them up, but I don't want to spend my time actually covering other things. But we can just say, still see that we're still a little bit off of where we want to buy this from. We already have some orders placed in there to buy these back. We can see the orders right here. And so it has a buy back there in Condor. Let's see, you got the vertical. That's the one we just did on the TNX. And then we got this UNH to buy it back at basically 285. And that's the whole thing. No. Oh, market's at 285. Sorry, 73 cents. And so it's still a little ways off. And so really what's happening here is it's doing fine. It just needs time. That rhymes. Doing fine just needs time. So nothing to do but sit on the hands and wait. Wait for time to go by and time decay to eat away those trades. So, all right, so good. So there's that. Now, with that said, kind of that time aspect of it, there's three things that really play a role in moving the value of the option. One of them is the price, where the stock goes. That changes the value of the option. The second one is time, right? As you get closer to the expiration, the time value diminishes, right? And so less of that option value is comprised of time because there's less and less time as we get closer to expiration. And the third thing is the implied volatility. Now, the interesting thing about the implied volatility is that's one that can actually um, change dramatically. Well, actually, price action can change dramatically. I'm just thinking of, time decay only goes in one direction, basically, right? We only get closer to expiration. We don't ever get further from expiration unless you're like Superman or something, go back in time or something, turn back the clock. But really, we just get closer to expiration. Yet implied volatility, it can go down and it can go up. Now, what I want to show is because I've had a lot of questions about the implied volatility. And so let's go over to a chart. And one of the ways we can look at implied volatility, in fact, let me pull something up. Let's go up to Palantir was one that was brought up, and that's a good stock to look at because it has been a bit volatile lately, right? We've seen some pretty good moves. It's one that we noted that spiked up. In fact, look at this one. It was, let me draw a line here. This one ran up and basically did kind of what we call bear flat, or bull flat. It's like a flag, but it didn't do that. It's a flag on the moon, because a lot of times flags will look like this, right? They'll be like run up, pull back like this, and then they'll run up again, right? But this flag is the moon flag, where it goes straight up and it sticks straight out. And so it still kind of counts as that consolidation period. It's a rest, taking a breather. And so from a technical standpoint, it still works that way, but it just set up a little bit different. And by the way, I've put together, some very quick YouTube shorts on things like that. In fact, I want to bring this up because I just did one on this exact topic. And so if you have not done so, if you've already subscribed to our webcast or to our Trader Talk channel, don't do it. But if you haven't, please subscribe and also hit the like button on this video. But one of the things I want to show you is you go over to our Trader Talk page, you go to Shorts, this right here, Shorts. And what you're going to see is a whole bunch of videos that are just simply, 3 minutes or less. Very quick. I have to get right to the point. And here, actually, right here is one that's just talking about bull flag patterns. And what I do is I've set up these, if you haven't seen these, I first started learning about like price patterns and a lot of these technical indications. I'd read it in a book, I'd study the images, I'd go look at a chart and I couldn't find it. And I'd find out they don't always play out like they're written up, right? So what you read in a textbook and say, this is what it should look like, sometimes you'll find it textbook perfect, but many times there's some variations. And I also wanted to go through, okay, when those variations mean something and when they don't, meaning sometimes the variations can actually ruin the pattern itself. And sometimes it doesn't matter. It's still, the pattern is still intact, or the idea behind it is still intact. And so I try to do it real quick, but go ahead and check that out. That will tell you about the bull flag price pattern that I was just mentioning. But check those out. I think that they're great. But anyhow, we have this one breaking out, right? Palantir looking to go higher. Now let's do this. Let's come into the little beaker. Let's get rid of some now. Let's just click on the beaker. And I'm going to bring up implied volatility, IMP. IMP volatility. That's what we want right there. IMP volatility. We're going to add that. I'm going to hit apply. And here's our implied volatility. Now, this is one way to illustrate it. And there's another way I'm going to show you here in just a moment. But what is the low in here? The low is right in here about 40. Well, overall, the yearly low is about 45. So keep that number in mind, okay? Generally speaking, these are kind of the lows in here, but the yearly low is down here about 45. I want to show you this in a different way. The yearly, okay, here we go. And the yearly high up here, what, about 82-ish? Yeah, 82 right there. So that's the low and the high. Now, those are the extreme points, right? And where are we right now? Well, right now about 52. So we're kind of at the lower end of this implied volatility range, right? Now, the interesting thing about implied volatility is and historical volatility, because they are different, all right? But implied volatility, and I'll go over and show you where you can find these, and I'll address a little bit in more detail. But implied volatility is forward-looking more so, and historical volatility is, as it states, historical looking. And so really, we're going to use that historical volatility kind of set the baseline, but the implied volatility is going to show us the market fear or excitement or something else that's playing a role in it that can change those option values, all right? But the important thing about implied volatility is understanding where it is relative to itself, okay? So there's going to be a couple things that are going to change that. Now, what I want to do is this is looking at the general from what I understand, several option expiration cycles, kind of the general idea of the implied volatility. If we were to go over to the trade tab and look, you'll see that each month has an implied volatility. Let's make sure we're on PLTR here. Each month will have its own, and it will change because if maybe one cycle has an earnings announcement in it, which is not in the next one, or there's a lot of time after that is released before the next one expires. And so that can obviously change the volatility that expiration cycle where you have an earnings announcement right near the end, because there could be a lot of movement there where something that expires 3 months after that, well, then it has a lot more time to kind of settle down, and it doesn't have as much ranked into that because there's a lot more known than unknown, if you will, meaning there's more time to kind of figure it out and can kind of get a bigger range on that. So anyhow, so these will have their own, but a good way to look at this is if I go out to I'll just grab one here on the option chain. I scroll down, and at the very bottom, it has this product depth. All right. So I'm going to click on that. Oh, wait, no. I want today's option statistics. Sorry, that's the one I want. Actually, let me make this a little bit bigger first. I'll see. Okay. I'm going to go up to the setup. I'm going to go application settings. When this comes up, if it will, I'm going to go to look and feel. When I get to look and feel, I want to change my font size. I'm going to go large on that. And hopefully I'll make it a little bit bigger so we can see this just a little bit better. Okay. So what this is going to tell us is what are where's the drawing tool? Here's what we want to look at is basically, let me change this. We're going to do this, is there is the 52-week high and the 52-week low. Now that's what we just saw on the graph, right? There's the 82 and there's the 45 that I just drew in. Now this is going to tell us it's 18%. And what does that mean, 18%? Well, it means right now, right here is currently at 52%. And if you were to plot 52% in that range between 45 and 82, it's basically, they're kind of restarting and saying 45 is 0 and 82 is 100. So where is it? Well, it's 18% up. Does that make sense? So basically by looking at that 18%, we can actually, that just tells us it's at the lower quadrant. It's quite low on that range. Now, here's what's important about implied volatility, because people will say, 52% is high. Generally speaking, I'd hear people say something like that. Now, the comment I'd say is, well, is it high? Is it low? How do we know? Well, really, it's relative to its area. Let me show you what I mean. Let me get rid of this. Let's go over and look at another one, okay? Let's go back to the charts. Actually, let me click on this. Here we go. Gonna be able to click on it. There we go. Let's pull up Chevron, CVX. Whoops. And then we're going to, come on, can I get that up? And we'll play some more trades here in a second. But this is really important to understand. So looking at Chevron, we have a high here. Where are we? Around 35? 35-ish? 35, 36, somewhere in there, right? And we have a low, I'm guessing it's somewhere around here, somewhere down around, I'm not getting too specific, but somewhere around about 20, it looks like. So where is it now? Well, you can see it's kind of at the lower side, around 25, all right? Let's do the same thing. Let's go over to the trade tab. Let's come down to today's option statistics. Let's pull up CVX. And what is it going to say? There's a 35, 36 that we had as a high. Here's the 20 that we had as a low, and this one's saying 34%. Now this one's actually quite low as well, and the current implied volatility is 25, 26%. So again, looking at that kind of makes sense, right? Like if we were to look at this and say, okay, here's the low and here's the high up here, and if this is let me get something else. Okay, so like this is 0 and this is 100, if you will, right? And that of that range, I mean, we could actually say it this way too. This is like 20, 25, 30, 35. Whoops, that was too big. And right here at 25, That's about a third, isn't it? Because we could almost break this into five, like 5, 10, 15, and that's the difference between, 20 and 35. So it's like there's a third, right? If it's at 25, well, that's where it's at, right? That current implied volatility says right there, 34%. So roughly a third of the way up off the bottom. And so that's all it's trying to tell you. Now, I mentioned I'd bring up the historical volatility, and we can see that in here as well. Like we can see the 52-week high, the 52-week low. We can see the range that's had on historical volatility, and it also shows us where is it somewhere in here where the current historical volatility, current historical volatility percentages. And so while this is here, we don't necessarily need this for option trading, okay? Because again, that's historically looking, and what we want to see is where is it now? Where's the implied volatility? And so one of the things that's interesting about this case is that this one, this we had one that had what, an implied volatility score of 52, another one at 25, and yet they're both on the low end. And why can we say they're both on the low end? Because they're relative to itself, right? It's kind of like saying, what's the value of your home? Well, the value of a home, if this home is next in some dump side of the city, they just put in a big factory behind it, lots of stuff. The value of the home might only be 300,000, right? So it might be on the low end because maybe in that town the homes range from about 200,000. Looks like one of our trades just got filled. 200,000 up to 600,000. Let's just say that's the range of homes in that area. Well, 300,000 would be on the low end. Well, maybe we go somewhere else. Maybe go somewhere. Well, maybe go somewhere else. And actually, I've done this backwards. Should have done this a different way. Oh well. Just understand that same home, maybe at 300,000 in some other area where the range of the homes goes from 400,000 on the high end. I haven't bought a home in a while, so actually homes are a lot more expensive than last time I thought about this analogy. 400,000 on the high end and 300 and 100,000 on the low end, right? Then all of a sudden that 300,000 is more on the upper end, right? And so it really is, which town is it in, So 300,000 could be inexpensive, 300,000 could be very expensive depending on where you're at. And that's the important part. It really depends on the option itself. So don't compare implied volatility don't look and say, okay, this is at 52% or that's at 25% or that's at 61% and say that's high or low. It has nothing to do with that. It's where it is relative to itself. All right. Now, generally speaking, as a seller of an option, we'd like to see those higher. However, it doesn't always make it ideal, meaning if it's high, sometimes it's high for a reason, right? Earnings announcement coming up, maybe some sort of a split or some major announcement of some sort, something that can shake that stock up, and that's something as an option seller that we typically don't want to ride through. So just understand that we're often fighting these two entities where we like to sell when it's high, but the high also means there's unknown and can create quick movement. And as that seller, we like to be kind of more, have a stronger understanding of where the movement could potentially be. So it just leaves us in kind of a conundrum where in the end, we just got to play it out and say, okay, what kind of risk do we want to take based upon where we think this might go? All right. Let me just make sure we're not missing any of the questions. Let's see. If you buy back the call side, the stock plummets. What is the management? Okay, I'll get into that, Randy. Let me go through another example here. 22 days to expiration. Not clear why we're trying to stop out. We're not trying to stop out, Sam. On those trades I was showing, we were simply looking for just time to expire, and then it wasn't a stop. It was a buyback. It was close the position, not stop us out a loss, buy it back for a gain. Let's see. Okay, looks like Connie addressed all. And by the way, Connie Hill, thank you very much for joining and taking care of everyone. Looks like you addressed a lot of those. Thank you so much. Mighty Mouse, good to see you. How much weight may one put on the current IV percentile versus the current historical? And there, speak truth, yeah, hopefully I answered that question as we went through there. Obviously, we're looking at the implied volatility. That's where pretty much all the weight is going. Okay. All right. All right, let's go ahead and I want to show you let's look at some, how about this? Let's do this. Let's go to GLW because I thought this was interesting. Now, because last week, I went through that example of putting on those short call verticals and short put verticals on the same stock and kind of showed you how we did them independently and they became an iron condor. Let's do it again. Let's do one more this week. And let's pull up GLW as an example here. Now, kind of looking as we kind of talk about that implied volatility, we can look at this and say, well, here it is. There's kind of the long-term low and long-term high is up in here. So come on, doesn't even want to draw up there all the way. So we have a low down around 24 and a high up around, well, 1. If we're currently at 62, I'd say we're about halfway, wouldn't you? Wouldn't you say it's about halfway? Should we take a look and see how our guess is? Let's go to the trade tab. What do we have? GLW as a symbol. Let's scroll down. Here to that. Here we go. So there's our high 99. There's our low 22. What's our rank? 52. We were pretty close on our guess, weren't we? We said halfway. So we're well, it's current AEV. I'm sorry. The percentile has 52%. Implied volatility at 62 is where it currently sits, and that's where we're at. So yeah, good guess on our end. Okay, so if I'm looking at this, so what I see from a technical standpoint is a stock. So we have implied volatility is fine, kind of in the middle there in that range. We have some resistance right across about here, I'd say. Look at this old high, support, breakthrough, new high, right? Well, the newer high came up, but resistance again. So we have something there. We have some in here as well. So kind of like this is a support resistance area. So this is one thing from a technical aspect. We could go and say, okay, what if we could do something and maybe a little bit more, we're a little bit more on the downside. So maybe we look to collect a lot of the funds on the downside and hopefully it bounce off that and move higher as it's looking to potentially make a higher low here. Maybe this is a start of the movement to the upside, right? If I were to draw a line, and by the way, a little bit early to be drawing this, but this is what I'm thinking is maybe we're getting some support and a bounce to move on the upside. So let's do this. Let's just go out there. We're going to look at the probabilities and we're going to see how those tie in to where these sit. So we got this like 143, 142, 143-ish, 44, somewhere in there. And we're also looking at the 170s, 174, something like that, maybe on the high end. Let's see what it offers us. So what I want to do is go out and let's pick one of the expiration cycles. We're at 1, 8, 15, 22, 29. Typically speaking, I like to look somewhere around that 30 to 40 day window. But I also like to put more weight on the typical monthly expiration just because they tend, not always, but they tend to have higher interest and tighter bid-ask spreads. And if we can make it work in 22 days, maybe we try it. Let's see what happens. Let's see what happens here. So let's go out there and let's sell something. Let's sell something around that 30 to 40 delta. So if I sell, let's see, what's this one? There's a delta. We use that delta as an approximation for being in the money. And so if that's 35% probability of being in the money. It's also a 65% probability of being out of the money. Let's go ahead and just kind of click on that one. We're going to sell that one. And then let's scroll down and buy one below that and creating our short call spread. So here's our short call spread, 162.50, 165. So that's a $2 wide spread, right? $2.50 wide spread. Get a credit of 72 cents for that. All right. And if we were going to analyze that, so I'm going to right click and analyze this trade. This is what we get, right? I'm going to come over here. I'm going to left click on this, those 3 slices or I don't know, lines here, and set slice at break even on our expiration. And here we go. This is going to tell us, kind of our percentage. There's, according to this, we have a 30% probability of being above that line and the 70% probability of being below that. That's our break even. Our max gain, as we kind of talked about, was a little closer to that 60-ish, 60, well, let's say 65, 66. The delta was an approximation. So this is giving us a little tighter percentage. So 69% probability of being, making the 100% gain on this one, potential gain, and, 30% probability of being somewhere above that, losing some or losing all. So we're bringing in that credit. It looks like it's bouncing around a little bit. Man, it was looking better a second ago, but we're still good. So that's the call side. Let's go back. I'm going to go to add simulate trade. I'm going to come back here. Let's do the put side. Okay. So for that, we're going to come down and I actually want to do something kind of different on this one. Let's do we got to do 18, any more strikes. So let's see. If we're kind of going with a similar delta, maybe we do. Let's go a little bit lower. Let's go with 32 delta. So let's go ahead and sell this 143. Now notice these aren't 2.5 wide. These are $1 wide. Can we do that? Yeah, let's go ahead and sell this 143, and then let's go back, and we're going to buy the 142. Okay. Now this is interesting because look at what this is doing. So this is this here is, in fact, let me go ahead and do a set slices at break even, get both of them in there. Oh wow, that didn't set a break even because here's what the deal is. So notice this is what this is the range we want the price to be in, the stock to be in, all right? Basically, if it's below this spot, we hit max gain. Let's move that over. There's our max gain, right? And here's our max, well, right here would be our other max gain. We don't have a line on there. But basically, this is saying we can't lose any money to the downside. Why? Because we're bringing in more credit in here. This credit that we're bringing on the call side. Now, we're not getting actually the credit we're getting on the call side is more than enough to cover on the put side. And so basically, we've erased the potential loss on the downside, and there's only loss to the upside. Now, that might be a little bit tight, though, on that upside. In fact, let's go ahead. I'm going to actually add a slice here. Let's see. Can I get a slice in there? Let's see. Where's my add slice? So there's one. There we go. I just added another one. Okay. I'm going to drag that one over. And what I can do then is take a look at how that looks on a chart. So I set both these slices. And by the way, wherever you set this, this is where it's going to end up on the chart. So make sure you get these where you want them. All right. So I got these at max gain for our trade here. And then what I can do is come down here on the little hamburger thing or whatever you want to call it and set slices to chart. And I'm going to come over and click on that. And let me remove everything. Let me remove all drawings because I think our they came in as the same color as the lines that we drew on there already. So didn't see them. Let me do that one more time. And then you'll see it there. So set slices to chart right there. Click on that. Boom, there they are. Okay. So now you can see that's kind of where we had things, right? Maybe a little bit low on that upside because I think we had the resistance up a little bit higher. And so maybe we need to move that up a little bit, give it a little bit more space on that upside right here. Let's change that different color so we're not confusing those. Edit that and change that to like a blue or something. And then the downside is still pretty close to what we had. Okay, bouncing off that support, the downside. So this is where we had it on the graph. I want to move these things down. I don't need these really. I want to focus on the price action. Okay. So here we go. We need price action to be between here and here. Now, if what we're talking about is true, and there's a little bit more of a bullish pressure, we may want to give it a little bit more range on that upside. Let's go back and take a look at this. And so what do we have here? That 165, 162.50, 165. And so we need to be below that 162.50. Let's move that up a little bit. In fact, let's click on this and raise that to 165. And then we'll raise that to a 167.50. So basically just shifted it up and give us, and you can see it right here. It just gives us a little bit more room on the upside. And so let me go ahead and right click on that and set slices to the chart. And there we go. That gives us a little bit more room. We're not quite at resistance, but it does give it a little bit more room on the upside. Okay. Now this is what they call, I mean, basically we have just a short put spread down here that we're getting that 35 cents for, and we have a short call spread up here that we get 67 cents for. Now altogether, this creates an unbalanced iron condor. Now, does it matter? I mean, we're starting to get into some more advanced things, but here's the point. It doesn't matter. You guys understand this is simply a short put spread and a short call spread. That's it. That's all it is. That's all it is. And hopefully you're understanding that why I stress in this class to get familiar with the risk profile, understanding what happens here, understanding by putting these two trades together and looking at it as one, that it removed the downside risk because this is zero, right? This is where, like if I move this, you can see the risk on the downside at expiration is it still makes $2 on the downside. The risk is actually all the way to the upside. Now, on the upside, we could lose 148. And you can see it by the blue. That's expiration, right? So, so we can lose 148 overall. We can make 102. Let's go ahead and actually send those off, shall we? Send those trades off. And I could put this all together as one trade, or I could do it in, separate trades. It really doesn't matter. That's another thing is if I did it as 4 separate legs, or if I did it all as, one trade, setting off all four option, it's the same thing. This is the same thing. Okay. Let's see. Looking at though, as one big trade, if we are risking, what is the risk on that? The total risk on that is about $148. So if we did 1,000 total divided by 148, then what do we get? About 6 contracts. And so let's put 6 contracts on each of these. There we go. As we do this, there we go. Got it all together. We'll go ahead and confirm and send. Now, one thing I should say as we do about this, if I do send it in as separate legs, then it is possible that one side fills and the other doesn't. And so it's something to kind of keep an eye on. All right. That is one big difference between creating it as one order to where all 4 legs fill, or, doing it as 2 orders where we got the call side and the put side, or even doing it 4 orders as, long call, long put, long, short call, short put. So, but just got them set in there. It looks like we got part of it going. So I'll keep an eye on getting into the rest. So a lot covered today. And really what I want to do is just kind of take you through and help you understand that as you move on beyond this class, as you learn these things, about these short verticals, you have all the components, all the ingredients you need to do more advanced trades. It's just understanding how they combine. And so hopefully today you picked up, how to manage some of those trades, like looking at it and just managing the winners, taking those off the table. We talked about the implied volatility, how to read that, like understanding what it means, what we're looking at, what the range is relative to itself, and that's very important to understand. And then also looking at placing other trades on there and even taking a step from not just making it equally weighted, but unbalanced, meaning we only had a 1 wide strike on the put side and a 2.5 on the call side. So a lot of stuff. Let me just make sure I didn't miss anything as we go through here. What are the mechanics of having entered 4 legs on an iron condor? I'm not sure I understand the question, but it's basically you just, when I say 4 legs, the mechanics would be just doing it separate, right? Just coming in and clicking on one of them and saying, let me do this leg, and then sending that off, and then doing the next leg and sending that off. And so it's obviously, it tends to be easier, just create all 4 and then send it off. But I want to do it as 2 because I want to do it as a class, as a short call vertical and a short put vertical. Comment, I usually do one side at a time with the intention of adding the opposite trade based on price movements. And that's an interesting concept. And so what some will do, kind of the idea here, is look to possibly add like one side, like the put side is getting a lot of value right now, right? Because it's lower, it's closer to the put side of where we look in this range. And so they add the put side right now, and then maybe wait a couple days if the stock runs up, maybe 2 or 3 days, then sell the call side, and then you can get a little bit more credit for that total trade. Now, the risk on that is if it doesn't run up, right? If it doesn't run up at all and it comes down, we don't have that call side to help give us some benefit when the stock drops. And so there's always a trade-off, but yeah, definitely. Thank you for that, Sam Flanagan. Let's see. Okay, yeah, you already mentioned all that. Okay, I don't know how to enter 4 legs on the platform. Let me show you how to enter 4 legs, and then we'll call it good. Okay, it's real simple. It's real simple. All we're going to do is, if we were going to sell this one, let me just do it on a different stock so we don't. I'm not going to do it on this one. I don't want to get them all confused. But here we go. We sold the 165, so I'm going to click on the bid. Then I'm going to go back and I'm going to click on the ask. I'm going to hold down the control key and hit the ask of the 167.50. And then we did the 143, 142, right? So I'm going to sell the 143 put. So I'm going to hold down the control, click on that. And then I want to buy the 142. So I'm going to hold down the control and click on the ask. And there it is. That's all 4 right there. And then just confirm and send that off. Okay. And you can see this is 97 cents. It's pretty close. We had what, 65 and 35. So we had, what is that, a dollar? We had a dollar when we looked at it separate, and here's 97 cents. So you can see it's essentially the same thing, right? So there we go. We covered an awful lot. Hopefully that helps you out. Again, we'll follow up on this, our existing trades, this trade, and let me know in the comments what questions you have as we went through all this. There's a lot we unpacked today. So let me know what questions you have, and we'll look to address them next week. And I look forward to seeing you then. Till then, take care.